Hey everyone, in this video I'm going to bring you one dividend stock you can buy now and hold almost forever, and I'm going to discuss why I like this dividend stock so much, why now is a good time to buy it, and what the catalysts are for this dividend stock to grow over the next decade or two or even more. So let's jump right in.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the dividend stock that I'm talking about here is Starbucks. Starbucks offers passive income investors a dividend yield of 2.31%, but I think Starbucks has room to grow this dividend over the next several years and more. The company is still growing locations, even though it feels like there's a Starbucks in every corner. We're going to talk in a little more detail about that a little later in the video. Starbucks revenue has grown over the last 5 and 10-year periods. You can see the growth rate here from 16 billion in the trailing 12 months in 2015 all the way up to 36 billion in the most recent trailing 12-month period. That's a growth of more than doubling in just about a decade, which is a pretty good growth rate when you're thinking about it's a brick and mortar business. Starbucks locations are in-person locations where people need to be there making those drinks, and people need to come and either pick them up or those drinks need to be delivered. So that constrains the rate of growth. And despite that constraint, Starbucks has still managed to more than double in the last decade. That's a testament to consumer demand for its products, for the perceived customer value proposition. People continue to desire to buy Starbucks drinks despite its premium prices, right? They're on the expensive side of coffee beverages worldwide. So that's good news for investors interested in a dividend stock that could pay dividends for not just this year or next year, but for this decade and next decade because of that strong brand loyalty, that consumer demand, that customer value proposition. That's going to be difficult for any competitor to encroach on this target market. Starbucks has done this while maintaining solid profit margins. So before the pandemic, Starbucks profit margins were steadily in the double digits, around 16 to 15% after the wild fluctuations during the pandemic. Of course, it had to shut down many of its in-person locations and then reopen. So that was a quick recovery. You see that big drop and then big bounce back, and now it's even better than where it was before the pandemic. Additionally, Starbucks is focusing on growing its locations internationally, which, if you look inside its financial statements, Starbucks locations in international locations are more profitable than domestic. And you can understand why. Labor expenses are lower, rent expenses lower in many of the markets that Starbucks operates outside of North America. So that's where Starbucks is focusing its growth ambitions for the next 5 and 10 year periods. It's not really focused on adding new locations in North America, although it will, but not as much as it's opening new locations internationally. And given that the international locations are more profitable, that proportional increase should work to increase Starbucks profit margins. Management said closer to 18% over the next 2 to 4 year period. So that's a catalyst to push Starbucks profitability higher over the next few years. Now, here is an excellent metric to demonstrate the effectiveness of Starbucks as an investment. Starbucks return on invested capital, ROIC, has risen significantly since 2015, where it was around 6%, all the way now up to 60.52%. That means that Starbucks utilizes capital effectively. Starbucks knows how to use its capital to generate a strong return on that capital. So when Starbucks goes to spend money, investors can feel confident that it's spending money on something that's going to bring in significant return on that investment. This is the essence of nearly every business, is being able to take money from investors, spend it on something that provides a service or product, and generate a meaningful return on that investment. How good you are at that process determines the returns that shareholders will get. That's the essence of being in business. And here, Starbucks demonstrates that phenomenally well, generating a 60.52% return on invested capital. That can partly be attributed to some of its locations being franchised. But again, that's a decision, and that decision has worked well for Starbucks. Also, when it comes to some of its products, instead of deciding to manufacture and deal with the distribution of some of its products that you might see in grocery stores and retail stores, Starbucks has partnered with other manufacturers and distributors to license their name out and then receive a margin from that transaction, which is more profitable than if Starbucks was to go out and put out all that capital from its own coffers. So all these decisions that Starbucks has made over the years have proven to be effective. And they've demonstrated that over a long period of time. And this is one of the primary reasons why I'm recommending Starbucks stock here. But also, Starbucks is one of my top 24 stocks to buy in 2024. So it's one of my top stocks that I'm recommending right now out of all of the stocks that I cover. And I've already discussed many reasons why. I've got a few more reasons I'm going to discuss here. So Starbucks' balance sheet is in a relatively strong position as well. It's got 15.4 billion in long-term debt and 3.95 billion in cash and short-term investments. And given that the business model Starbucks chooses is to be asset light whenever it can, choosing to partner with a different company when it comes to manufacturing, logistics, and distribution, choosing to go with the franchisee route where a lot of the new locations that are opened are franchisee based. So Starbucks doesn't need to put out that money that it has to make a new location. A franchisee can make that new location and then send Starbucks cash every time it makes sales. That's a lucrative business model that doesn't require very much cash up front. And so Starbucks can have this kind of balance sheet where it has more debt than cash because it's effectively using the cash that it has to operate the business. And finally, Starbucks stock is arguably cheaper than it's been in the last 5 years or so. Investors can get Starbucks stock at a forward price to earnings ratio of 19.37, which if we look back over the last 5 years, there's only really been one moment where Starbucks stock was cheaper, and that was in the immediate aftermath of government lockdowns, where the stock price collapsed but then quickly bounced back. So you're getting Starbucks stock now at almost the same valuation you were getting it when it had all of its store locations closed for in-person purchasing and sitting and enjoying, right? So in my opinion, these are excellent reasons why dividend stock and passive income investors can buy Starbucks stock now, and you can hold it for the very, very long term, almost forever. I don't see Starbucks going out of business anytime in the next 1 or 2 decades unless there's an unforeseen disaster that comes upon Starbucks. So it's one of those, what I like to call forever stocks like Coca-Cola and Pepsi. I put Starbucks in that category. Although not up there along equally with Pepsi and Coca-Cola, it's still up there in the ranks of those companies that I suspect will be around for a very, very long time. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.